The close of yesterday was unusual. If you look at the bars here, this bar is actually, let me do this so you can see. This bar, it's actually a small bull bar, and therefore we had 12 consecutive bull bars. And you can say, oh, big deal, 12 bull bars. It is a big deal because I've been doing this a long, long time, and I don't ever remember seeing 13 consecutive bull bars. I have seen 12 before, but I've never seen 13. And a streak is a behavior that lasts a long time. So if you have 2 bull bars, you have a streak of 2 bull bars. And here, you have 85 bars above the moving average. Extremely rare. That's a streak. Bar after bar stayed above the moving average. Here in the middle of the day, we have a streak of 17 bars where every low is at or above the low of the prior bar. And then here we finally have a bar with a low below the low of the prior bar. So the streak, the bull microchannel ended. We finally had a pullback. Well, I'm wrong. Here's a streak of 13 consecutive bull bars. I said 12. Well, here's one, 13. This goes back about 10 years. That's probably the biggest streak that we've had in about 10 years. And there was follow-through buying here, right? That's a sign of relentless, very aggressive bulls. So you'd expect traders to buy the first pullback and for the market to have some follow-through buying, but it's also climactic, and you can see what happened the next day. I'm not saying today is going to be a bear trend day. However, this is extreme behavior, and yesterday we had extreme behavior. Here's a streak that occurred on the open, 11 bars without a pullback, and then we had follow-through, but it's climactic, and we got a sell-off later in the day. This happened a couple of days ago. Here's a streak of 12 consecutive bull bars, and we had some follow-through. 13 consecutive bull bars, so another 13, and we had quite a bit of follow-through. I don't know what we're going to get today. I don't know if we're going to do that and have a lot of follow-through buying, or if we'll have limited follow-through buying. And sometimes it's climactic. You can get a reversal out of it. Here we had a lower high major trend reversal. This high is slightly below that. However, if you look at most of these streaks, okay, we had one where we had a reversal. We had one that was mostly sideways, but the others, here's a streak and follow through, streak and follow through, streak and follow through. So chances are we're going to get some follow through buying today. I put in this 50% pullback line on the daily chart. I just messed that up. We had that sell-off in September, and we're almost to 50% of a pullback. So that is always resistance. Remember, I'm working on a laptop, so things are pretty small. And we're just below that 50% pullback. If you remember the last time I was in the chat room, I said there was a very high probability we were going to rally back above the August 18th low because we're in a trading range, and when the market is in a trading range, it tends to retrace beyond breakout points. We broke below this, went above it. Broke above this, went back below it. All through this trading range, every time we broke out above something, we pulled back below that breakout point. And therefore, in here, we had a strong rally, but we fell below the breakout point. Here, we had a strong sell-off, so the odds were high that we were going to rally above the breakout point. And I said we might rally for a couple of weeks. It's possible we'll go all the way up to a new all-time high. Maybe we'll get a big wedge, 1, pullback, 2, pullback, 3. but I think the trading range is going to continue even if we do get a new high. Is this the same as October last year? And we rallied for just about a year after that reversal. Is this the same as that? It might be. I don't think so. I think we're much more in the middle of a trading range now. So I think it's less likely that this is just going to go straight up to a new high. The two important prices on the chart are the all-time high here last year and then this October low. And I think we're going to go beyond both. I think we'll probably go below the October low before we go above the all-time high. And I'll go with that date back, October 13th. Very important price. So I think we're going to go below this before we go above that. And right now we're pretty much around the midpoint of the two key prices. First bar of the day, big bear bar after an extreme buy climax. Can you sell below the low of that bar? No, because two things. One is it's the first pullback in a very strong rally, so chances are the first reversal down will be minor. And two, you don't want to be selling right above the average price when the market has been above the average price for a whole bunch of bars. Here it's been above the average price for 25 bars. So chances are if it gets to the average price, it's going to bounce. But that does not always happen. When we had that streak the other day, here, we had 11 bars without a bear body. This was a perfect doji. And we have a small parabolic wedge. Chances are the first reversal will be minor. The bulls tried to get a bull flag, and instead of going up, it collapsed. And it became a bear trend for the remainder of the day. So I would call this a major reversal, even though it's only about a 50% pullback. It was 50 bars of going down. So it's a major reversal, but we did not have a major top. We only had a minor top. Parabolic wedge that's only 7 or 8 bars, and it's in a really strong bull trend. Chances are the best the bears would get would be a trading range. Instead, they got a bear trend lasting about 50 bars. So maybe about 30% of the time, you'll get a minor top that leads to a major reversal. So 70% of the time, you do not. So chances are this is going to be a minor reversal and not the start of a bear trend. It's so extreme, we might get 2 or 3 legs down. Maybe we'll get a wedge. We've had a lot of wedge bottoms lately. Can you buy above 2? Will traders be so eager to buy after yesterday's strong sell-off that despite this bear bar, they'll buy above 2? They might. If 2 closes on its high, I think it's okay to buy, but it would only do it if you use a very wide stop, like somewhere way down here. So you'd have to risk like 15 points. I would rather wait to see if we get a couple legs sideways to down. This is a climax. And when you have a climax and you start to get profit taking, typically you'll get at least a couple legs down before the bulls will buy again. Everybody knows it's climactic. Everybody knows it's going to attract profit taking. And sometimes the profit taking leads to a bear trend. The bulls usually want to give the bears a couple chances to convert the bull trend into a bear trend before the bulls will buy again. So the bears made one attempt here. The bulls will probably want to see the bears get a second attempt and fail twice, and then the bulls will buy. 2 legs down, 1 pullback 2, so a high 2 or a double bottom. So chances are 2 is not going to be the low of the day. Now, if 2 has a prominent tail on top, there probably will be limit order bears selling with at the high of 2. If 2 is a bull bar closing near its high, I would not sell it. Now, the bears, okay, consecutive bear bars, one being big and closing near its low. Does it sell the close? Well, normally it would be, and I would sell the close if it was far above the moving average. I would sell the close if it's below the moving average. but I really don't want to sell the close when it's just above the moving average, because there will be bulls looking to buy at the average price. They've been willing to pay an above average price for 30 bars, and a lot of them will seize the opportunity to buy at the average price. But smart bulls will say, we had a similar situation a couple days ago, and instead of traders buying at the average price, we collapsed through it. I don't think that's going to happen. Here's an example. This is what I'm talking about. Here we had 11 bars without a bear body. We had strong follow through. So a lot of bars up, 33 bars up in a very tight bull channel. Should be buyers at the moving average. And when we finally got to the moving average, this did not quite reach the moving average. When we finally got to the moving average, the bulls who had limit orders to buy at the moving average got overwhelmed by bears selling. And so it can happen, but it usually doesn't happen. 70% of the time, if you have a very strong bull trend, a bull trend that stayed above the moving average, or 20 or more bars, that's one measure of a relentless buying campaign by the bulls. The bulls will buy at the moving average. Sometimes it'll drop below the moving average for several bars, but 70% of the time it'll go back up and test the high. So right now, there's a 70% chance that we're going to come back up here at some point in the next hour or two. But we're probably going to need 2 or 3 legs sideways to down before the bulls will buy. On the open, the market often makes a big move up or down, and it's searching for direction. And sometimes that big move is the right direction, and you get a trend right from the open. But half the time, it's the wrong direction. Yesterday, we had a big bull bar on the open, wrong direction. We went down. Here we had a couple strong sell-offs, wrong direction. We went up. Here we tried to get a double bottom bull flag, a good-looking buy signal bar, and we broke strongly below it. But this was a failed breakout, and it led to the low of the day. Here, a couple strong sell-offs and wrong direction, and then we got that. An extremely big outside up bar closing on its high, closing far above the prior bar. I would buy that. I'd buy the follow-through bar, and it turned out to be the start of a big bull trend. Here we had a big bull bar on the open. You can call it a wedge, you can call it a double bottom, an attempt by the bulls to resume this trend, but it was a trap. Instead of the market continuing up, we reversed down, and it was the high for the next couple of hours. Here, 2 consecutive big bull bars, one of them closing on its high, but we did not go above the high of the second bar. To me, that would be the buy. Instead, we reversed, and this was a bull trap. It led to a sell-off. Here we had a strong rally, and then a very big sell-off. Is this a resumption of the bear trend? No, it formed a higher low, and this was a bear trap, and so we got a higher low double bottom. This was just a sharp pullback from this, and that led to a trend up. At the moving average, our traders are going to buy it. We may have to come down here. The market thought this was a fair price. It was sideways here for about 10 bars, so we may have to come there. We may have to come down to about a 50% pullback. There's 50%. And that August 18th low on the daily chart, right here, you can see, here's the daily chart, and you can see we're just above that August low. So we might be testing that as well. At some point, if it keeps going down, you have to decide that it's a bear trend, even though this is extremely bullish. At some point, you have to decide that this is just a buy climax and an opportunity for the bears to sell around the 50% pullback. We tested on the daily chart this big gap. We went above this high. Okay, for a couple of days. The last 2 days we were above it. Today we were not. And the bears sold again here. There was so much, the bears were so eager to sell. After this close, the market opened down here. And so we're around this price, the start of that sell-off. Are the bears going to sell again here? Probably not. This is really strongly bullish. So even if we come down, I think it's enough of a surprise rally that we'll get a second leg up. So even if we come back down here, I think we'll get a second leg up. So I think there's now a downside. Now, we've had 3 consecutive bear bars, but we're still testing the moving average. So there still might be buyers in this general area. This is a big move up. This is a big move down. And when you have a big move up and a big move down, it's confusing. Is the move down simply a pullback from this, or is the move down start of a bear trend? And when there's confusion, traders are afraid. They don't want to buy too high because they're afraid we might get another reversal down. And, they don't want to sell too low, even with 3 bear bars, because they're concerned that this could be just a pullback in this, and they don't want to be selling it below. So traders prefer to sell rallies and buy sell-offs. And because of the reversal and the strong move up and the strong move down, they're concerned about more reversals, and therefore they don't want to hold on to positions. So they buy low and they take quick profits. And they sell high and they take quick profits. And if traders are buying low, selling high, and taking quick profits, you're going to end up in a trading range because it'll contribute to the reversals. So whenever I see big up, big down, I think big confusion and trading range. So we're probably going to have a trading range open. We may have to come all the way back down here to the start of this buy climax, because that's very typical. Whenever you have a buy climax or a sell climax, the start of it is a magnet. Here we had a sell climax, and we rallied up through the high and stalled. Very common. Here we had a buy climax, and we rallied down to the bottom and stalled. The market's deciding, are we going to form a double bottom, or is the sell-off the start of a spike and channel down? Yesterday was a spike and channel down. So a big bear breakout, and then a second leg, and then ABC pullback, and then a third leg. So a spike and channel, and we got a reversal. I really wish I was in the room yesterday, because all during this reversal down, yesterday sell-off, I guess I just knew that we were going to rally. And why did I know that? Because there was something wrong. There were several things wrong with the sell-off. Here we have a low 2 top, low 1, low 2, a bad sell signal bar, a bad sell signal bar. Here we have a low 1, a bad sell signal bar. Here we have a micro double top, a low 2, a bad sell signal bar. Bad sell signal bar, bad. Bad sell signal bar. Bad sell signal bar, bad sell signal bar. Bad, right? Bad. So 90% of the sell signal bars were bad. They're mostly bull bars. And you don't get that in bear trends that last all day. You get a lot of good sell signal bars. So something was wrong with that. Also, the bulls who bought at a prior low, even if there was a big breakout, and if they bought more lower, 5 and 10 points lower, the market came back above the breakout point, and they were able to make money. They bought at this low, they bought at this low, they bought at that low, they bought at this low, and they buy more lower, and it comes back above the breakout points. So there were no gaps. And if you have a bear trend and there are no gaps, it's probably not going to last all day. So limit order bulls were able to make money the entire way down, and all the stop order sell signal bars were bad, except for this one. But even then, I don't even think it fell enough for a 5-point scalp. So something was wrong with this bear trend, and therefore it was unlikely to last all day. If a bear trend is not going to last, what's going to happen? There are only 2 other possibilities. One is it stops going down and it enters a trading range, and the other is it stops going down and it reverses and goes the other way. Getting near, now we've had consecutive bear bars closing below the moving average with decent sized bodies. So it's sell to close. It's okay to sell on the market, sell below 4, but if you do, your stop is up here. Remember, a trading range is most likely, so most likely up and down and up. And we don't know if up starts here or if we have to go down here and it stops. We're just above the 50% retracement. We're just above the start of the buy climax. So there are magnets a little bit lower. So sell the close, but if you're selling the close, you're hoping that we're going to do the bear version of this and just get a whole bunch of bear bars. But we're probably not because of what I said. Very strong up. The first reversal down is probably going to be minor. Very strong down. The first reversal up is probably going to be minor. So we may go a little bit lower, somewhere down here, but we'll probably get a reversal either from here or here. And if we go up, there'll be sellers up here, somewhere up in here. We're also testing the 4,400 big round number. So what do you do here? Well, it's more of a arguably, it's sell the close, right? We're always in short, sell the close, but it's probably a minor reversal because this is so strong. So I don't want to be selling low. Limit order bears, they will sell before high, and they will sell 5 points higher, 10 points higher, stop above yesterday's high, and they'll make money. Either it goes just a little bit above the 4 high and goes down, and they can make 5 points, or it goes 5 or 10 points above the 4 high, and then comes back to the 4 high. They can get a break even on their first buy, on their first sell, and with a profit on their second sell and a bigger profit on their third sell. So limit order market. Always in short, probably sellers, more sellers than buyers above 4, but probably we're not going to go down a lot more. What about the 20 gap bar bulls? We were above the moving average for 25 bars from 57 to bar 2. So there'll be buyers around the moving average. But after this many bear bars, a lot of the bulls will want to see the market stop going down, start to go sideways, and then get a good buy signal bar, and then they'll buy. So most bulls are not going to be buying above 4 or 5. Probably more sellers at the 4 high. But because we're low in a bear trend, that's probably going to end soon. Most of the bears who sell the 4 high are looking for a 5-point scalp, maybe a 10-point scalp. What about the Fed raising interest rates at the next meeting and the recession? I know a lot of really smart people are saying soft landing. Jamie Dimon, he's probably the smartest banker in the world and the best banker in the world. He's generally considered to be. And he does not believe we're going to go into a recession. But he's also a political character. And, I think sometimes when he says things, he's not saying things because he believes they're true. He's saying things out of an obligation because of his position. People see him as the most important financial person in the world. So, what he says is it's almost as important as what Chairman Powell says. So I think he's trying not to panic people. I think what he's saying is, maybe we'll go into a recession, but it's probably not going to be a bad recession. Now, limit order bears are sold before high. Some will scalp out with 5 points. Some will scalp out with 10 points. Some will hold, hoping that we come all the way down here. Okay, we just retraced 50% of yesterday's rally. We've got this cluster of sideways bars, and we have the bottom of the buy climax. Very often, when you get a reversal from a buy climax, the market comes all the way down to the bottom, sometimes a little bit below. The bulls are hoping this is just a deep pullback from this, so they'll try to keep the market from falling below. But since we've been sideways for 3 days, and when the market is sideways, it disappoints bulls and bears, chances are we're going to go below the 70 low and disappoint the bulls. But chances are we're not going to go a lot below, and that will disappoint the bears. So big up, big down, big confusion, trading range likely. Right now, always in short, but probably not a lot more to the downside. You know, below 70, yes, but probably not below yesterday's low. We're far enough below yesterday's high to it increases the likelihood that we will not go above yesterday's high. And simply because this is so strong, we're probably not going below yesterday's low. So we're not going below yesterday's low. We might not be going above yesterday's high. So today might remain an inside day within yesterday's range. Also, yesterday's range was good size, about 45 points. So there's plenty of room for today to be 30 points, 35 points, and not break out of yesterday's range. Get around a 50% pullback. Now, if we reverse up here, is it the 20 gap bar bulls buying, or is it buying for some other reason? The further below the moving average you go before you get the reversal, the more likely the reversal is because of something else and not because of the moving average. So maybe it's a 50% pullback. Maybe it's a test of the bottom of the buy climax. So right now, I would say this is probably a failed 20 gap bar buy setup. 70% of the time, you come down to the moving average, maybe a little bit below, and you test the prior high. 30% of the time, you don't go back up there, you just keep selling off. You know, I showed that example from a couple of days ago here, above the moving average for a lot of bars, more than 20 bars. And when it finally got to the moving average here, instead of bouncing and going up to test the high, the market collapsed. So that happens 30% of the time. Bears are hoping that we do this and go below the buy climax low. And once we did that, back up. Stop for the bears now. I would get out the size of a scalp above the high of any bar, because if it goes the size of a scalp above the high of a bar, then stop order bulls could make money. Traders selling here at the bottom of a bear trend believe the bear trend is strong. A strong bear trend, bulls are not going to be making money, even with limit orders, and they're certainly not going to be making money with stop orders, which requires an even bigger rally, right? So if it goes above the high of the prior bar by enough ticks for the bulls to make money, then it's no longer a strong bear trend. If it's no longer a strong bear trend, do you really want to be holding short near the bottom of the trend? No, right? If it's not a strong bear trend, you want to sell rallies. You don't want to be selling at the low. You don't want to be selling closes. So instead of keeping a stop above 5 or above 1 or above yesterday's high, if you're short, I think it's better to get out above a bull bar closing near its high, this bull bar closing over this midpoint, or get out the size of a scalp above any bar. Now, is this a possible low of the day? We dipped below the bottom of the buy climax, so we'll probably stall or rally. If we have a report at 7 o'clock, the market always, what I was going to say is, we should always assume there's a report or some kind of a news announcement at 7 o'clock, and it's a tricky time to buy because a lot of times, as soon as bar 6 closes, the market makes a quick move. So you don't have enough time to assess whether you should buy above 6. 6 is not a strong buy signal bar, so I think most traders should not buy above 6. It's 2 legs down, 1, bounce, and then 2. It's a bull bar, but it's the first bull bar after 5 bear bars. and it's not a big bull bar. Look at the size of the bull body compared to these bear bars. So it's not a big bull bar compared to the bear bars, and it has a fairly conspicuous tail. All of those things make a reversal above 6 likely to be minor. Somebody buying above 6, can you buy above 6 and put a stop below 6? No, because it's not a high probability buy. If you're taking a buy setup that's not high probability, you need great risk reward to offset the low probability, and that means you need a big profit, or you can try to increase your probability. It's unlikely you're going to get a big profit. So buying above 6, you're not going to get great risk reward. You do not have great probability. To increase your probability, you have to worsen your risk reward. So if you buy above 6, you buy more lower, like at the 6 low or 10 points lower or 15 points lower. So I would only buy above 6 if you can use a wide stop, like maybe a couple points below yesterday's low, and scale in lower. And most traders should not do that. Still a sell the close bear trend, but I would get out pretty quickly on a reversal up. I'd get out above a bull bar, closing above its midpoint, so I'd get out above bar 6. I'd get out the size of a scalp above any bar, including a bear bar, because that would be a sign that the bears are no longer as strong as they were. Bulls did not go above 6. Now they'll try to get a micro double bottom. They're trying to reverse up on 7 or 8. A bull bar and 2 legs down, 1 pull back, 2 pull back. So this is a third leg down, increased chance of a third reversal up for a couple legs, parabolic wedge. So, most traders should not sell the close of 6. Most traders should not sell on a stop below 6. They should wait and exit above 6. Can you buy the 6 low and put a stop below yesterday's low? You'll probably make money, but it's still a sell the close market. I think it's better to wait for more evidence that the bears will buy back shorts, more evidence that the bulls are willing to buy. We've only had 1 bull bar in the first 7 bars, and it's a small bull bar, so that's not very much buying. Let me get rid of this 50%. We're below the buy climax low. I'll get rid of that. We're in an area where the market went sideways yesterday, here and here. So chances are we're going to start to go sideways. For 10 bars, I don't know, 15 bars, chances are we're going to start to go sideways here. Bulls will look for a bad sell signal and buy below it. They'll also buy below a bull bar. Some bulls will buy below 6 if they can scale in lower and use a wide stop. And bears will look to sell a rally. I would not sell the 6 high because we're probably in a trading range, big up, big down, big confusion, and I don't want to be selling too close to the bottom of the range, so I'd rather be selling somewhere up in the middle of the range. Is this a parabolic wedge? Sure. We had 3 legs down, 1 bounce, 2 bounce, and 3. Doesn't look like it, but it is. Let's see, maybe it's clearer on the smaller time frame chart. But 1, 2, pull back 3. Okay, micro double bottom. You can call it a parabolic wedge. You can call it a high 2. Here's the first reversal up, and then if we go above 7, that would be a second reversal up. But it's still a tight bear channel with only 1 small bull bar, so it's probably a minor reversal. And you can only buy a minor reversal if you can use a wide stop and scale in, because a minor reversal means it's probably not going to lead to a bull trend. That means it's only going to lead to a small profit. and the probability is not good. So if you're buying something with low probability, you have to make your risk reward worse for the trade to work out. You got to greatly increase your risk to increase your probability. I talked about blackjack the other day, and that's an example of that. Everybody, 100% of people can make money playing blackjack if after every loss they double their position size. And the problem is the math favors the casino because, maybe there's a 70% chance you'll get 3 consecutive losses, a 60% chance 4 consecutive losses, maybe only a 1% chance you'll get 10 consecutive losses. But if you keep doubling your position size and you are able to do that indefinitely, eventually you'll make back all of your losses, plus you'll make some money. So in other words, you're improving your probability by increasing your risk. If you've lost 7 times, 8 times, 10 times, right, and now you're doubling your position size repeatedly, now your bets are extremely huge, so your risk is extremely big, but you're also increasing your probability to 100%. You're not going to lose every hand from now until eternity. Eventually you'll win, and if you're able to double your position size after every loss, it'll result in you making money. So you lose $1, and so next on a $1 bet, you bet $1 and you lose $1. Second bet, you bet $2. If you win, you made back the $1 that you lost. If you lose, now you've lost $3 and you double up on your next bet, so you're betting $4. If you win $4. That more than offsets your loss of $3, and you can just keep carrying that out. But the problem is the size of the bet gets really big. So 1, and then 2, and then 4, and then 8, and 16, and 32, 64, 128, 256, 512. So after 10 losses, you're betting $512 each hand. And if you're a trader if you're a gambler who initially is only betting $1, are you going to be able to bet $512? No, right? So, and if you're a person who can bet $512, are you going to want to start by betting $1? No, because you might have to wait 5 hours before you get to a $512 bet, and you'll feel like you're wasting your time. You won't make much money even if you're winning. So it's one of those theoretical things, and this is a similar situation. If you can keep doubling up or simply adding more, indefinitely, you're going to make money. Is that certain? Yes, 100% certain. If you buy at the market and buy more 10 points lower, 20 points, 30 points, and you just keep doing that all the way down to 0, there's 100% certainty you're going to make money. But is your account big enough to do that? And the answer is no. So 100% probability that the market is never going to go to 0, at least not in your lifetime. But you're risking more than what you have. You cannot do it. Trading range likely. 4 bars with prominent tails. Every tail means the market went one way and then it went the other way. So every bar for the past 4 bars, now 5 bars, has had a reversal. And a reversal is one of the signs of a trading range. So bar 4 is the start of trading range behavior. Now, the bulls who bought about 6 or 7 have not yet made money, but they probably will. So we'll probably get up here. Just like we had a buy climax here and we dipped below it, we have a sell climax here, so we're probably going to go above the 5 high. It's possible we just go straight above it over the next few bars. It's possible we come down and then go above it, but we should get above it. If I thought today was going to be a big bear trend day, I would bet we're not going above the 5 high. It should not go above the 5 high. If you get a big outside up bar early in the day, and the day's a big trend day, you're usually not going to reverse it here. A really big outside up bar, to me, this is a gift. And you see that, especially in an oversold market, with the bar closing on its high, closing far above the high of the prior bar, a very big bull bar. It's by the market, by the close, on a stop above its high. And then you get a second bull bar, same thing. It should not go below the low of that bar if it's going to be a trend. And if it's going to be a trend, it could go a long, long way. So it's worth buying, putting a stop below, and going to Walmart and come back in a couple hours and see how you're doing. And that's that Walmart strategy that I sometimes talk about. Now, what happened to all these bears? As I said, big up, big down, big confusion. This is not going to last all day. It's probably a bear leg in the trading range. But it's strong enough so that the first reversal up probably will be minor, which means we're probably going to test back down to 4,400, possibly all the way back down here. When does it become by the close, always in long? Well, we got a surprisingly big bull bar. That's good for the bulls. A lot of the bulls will want to see a follow-through bar. Now, the bears, if they sell the 7 high, they can only do it if they use a wide stop and scale in. So they sell the 7 high, 5 points higher, 10 points higher, 15 points higher, and maybe put a stop above yesterday's high. If they do that, it's a profitable strategy. And remember what I said about the bulls? I said they want to buy, but they only want to buy low. And I said the bears, they want to sell, but they only want to sell high. And we're around the 50% retracement of this. So you'll start to get bears looking to sell, and you'll start to get bulls scalping. A lot of the bulls have bought above 7 know the reversal up here is probably minor, which means it's probably not the start of a bull trend. So they'll look to take quick profits. Some had limit orders to exit with 5 points. Some will exit at 10 points, and others will exit as soon as they see the market start to stall. Like around the 5 high, you can see we're stalling. The bulls are hoping this is the start of a big bull trend, but they need more evidence, more than just seeing a 10 or 15 point rally. They need to see bars closing on their highs. They need follow-through bars like yesterday. But chances are disappointment. Anytime the market does something bearish, traders are going to buy. Anytime the market does something bullish, traders are going to sell. We're getting late in the hour, bar 9. Traders are starting to think about the appearance of the first 60-minute bar. 60-minute chart. 2 really strong rallies, and then a lot of small bars, a lot of sideways bars, a lot of prominent tails. Trading range behavior. The bulls are hoping this is a resumption of this, what is it, 7 or 8 bear bars and a bad buy signal bar outside up with a big tail on top. So even though these 2 bars are closing on their highs, there's probably not a lot more of this rally before we pull back more. So instead of this just going straight up, we're probably going to do this for a few days. The minimum that the bulls want is a close at or above the top of the sell climax. And you can see they did not get it. Okay. Their big breakout bar, 9, closed above 8. A bull bar closing near its high, so it's a breakout, but it did not close above that. That's a problem for the bulls. The bulls, the reversal up is not as strong as they want, so the bulls have bought above 7 or above the close of 8. What are they doing? A lot of them are selling, taking profits. They were hoping for more evidence that this is going to be a big trend. One of the things they would have liked is for 9 to close on its high, and they also would like it to close above a significant price, the 5 high. It did not. Are we always in long yet? We probably are, but a lot of traders would like to see a second consecutive bull bar after 9. And is it buy the close? It's possible this is the low of the day. I think it's more likely that we're in a trading range. So in trading range, I don't want to be buying too far above the low. And even though we had a big outside down bar here, remember I said I really don't want to be selling too far below the high because I think we're in a trading range. So what do you do here? The bears are hoping double top 5 and that this is a bull trap and that we're going to break below the neckline and fall for a measure move down to the 60-minute moving average in yesterday's low. But that's probably not going to happen. Big enough bull surprise, we're probably going to get a second leg sideways to up. If the bulls are lucky, we'll pull back here and get a good buy signal bar for a second leg up. And for the bears, you could sell it and take a chance that this is a bull trap. I would not. I'd wait for a second sell. So down and then up and then a second reversal down. Now, the 7 high, not a strong buy signal bar. Some bears sold the 7 high. They sold more 5 points higher. It did not go up 10 points higher. Those bears are betting we're going to dip at least 1 tick below the 7 high, which we probably will, because in a trading range, the market usually dips or goes beyond important prices. We went beyond the bottom of this buy climax. We went above the top of this outside down. We have a bad sell signal bar. The bears have sold at its high and sold more 5 points higher. We'll probably be able to get out break even on their first sell and with a profit on their higher sell. Near the end of the first hour, the bulls would love to have the first hour be a bull bar closing near its high, so they'd love bar 12 to close up here. The bears would love the hour to have the big bear bar closing on its low, so they want bar 12 to close down here. Neither one is probably going to get what they want, so then they'll fight over the midpoint of the hour right here. Will the first hour close above the midpoint, which would be more bullish? Will bar 12 close below the midpoint, more bearish? Now, some bears sold with a limit order at the 5 high. They'll sell at any prior high and sell more higher, but it did not fall enough for them to make money. If they want to make 20 ticks and they sell at that high, it has to fall 21 ticks below it. And this did not fall 21 ticks below. That high is 575, so it had to fall to 0.50, and it fell to 1.0. So it needed to fall another couple ticks. So far, the bears have sold the 5 high, have not made a scalp. And because they've got near their limit order to exit with 5 points right here, but did not reach it, a lot of them are buying back their shorts here, and that's what's creating that tail. They were hoping that there would be enough follow-through selling on the reversal down for the market to reach their limit order, and there was not. So bears are buying back shorts. Now for the bulls, they're hoping this is a bull trend. This is a pullback, a high one, but it's a bear bar, and we're probably in a trading range. So there probably are more sellers above 10 than buyers. So even though it's a bull trend or an early bull trend, so for the bulls, they're hoping it's an early bull trend, but it's a bad buy signal bar. So probably sellers above. And for the bears, they have a double top, a higher high double top in a bear trend, but they have a bad sell signal bar, 10, after a pair of decent bull bars. So not many bears will sell below 10, probably buyers below and at the 7 high. and probably not a lot of bulls willing to buy above 10. Remember, they'll buy at the high of a bull trend if they think it's a strong bull trend. But this is not yet a strong bull trend, so probably not a lot of bulls willing to buy above 10. So probably sellers above 10, buyers below 10. Right now the fight is over the end of the first hour. And are we going to close around the midpoint, slightly above or slightly below? Are we going to close at the high? Or are we going to close at the low? Probably we're going to close around the midpoint of the hour. So the hour will probably have a bear body. And then the fight will be whether the bear body closes above its midpoint, which would be more bullish, even though it has a bear body, or whether the hour closed below the midpoint, which would be slightly more bearish. Limit order trading. Not a good sell below, not a good buy above. Probably more sellers above and more buyers below. Trading range open, so we're probably going to be sideways here, maybe for another 10 bars or so. Might go up a little bit more, might go down a little bit more, but probably we're going to be sideways for about an hour. 90% of days, the market breaks out of the Globex range. Here's the Globex low. This is a Globex chart, and we fell below the Globex low. Here's the Globex high. We could get up to the Globex high, but that's about 25 points above where we are, and we've had a big sell-off. So we're probably not going to go above the Globex high. But this looks like a pullback of this. Even though it's a fairly strong sell-off, it does not look like it's erasing all of this. So we're probably not going to go a lot lower if we do go lower. High one, but I think not good enough to buy. Probably limit order bears will sell the 10 high and sell more higher. What happens if we get a pair of bull bars closing on their highs, 11, 12, and they have decent sized bodies? Then it'll be buy the close, but we're probably not going to get that. But if we get it, I'm going to buy. I'm not going to say, oh, this shouldn't happen. If something shouldn't happen and it does happen, I don't care about what should. All I care about is what does. So if something happens and it's not supposed to happen, to me, I'm going to trade what's in front of me, not what I think should have been in front of me. When you look at this chart, what do you think? Do you think bull trend? Or do you look at it and say, yeah, we're rallying, but we've got some bull bars, but something doesn't look right, right? And what doesn't look right is all these bear bars and the lack of consecutive big bull bars closing near their highs. So it's not behaving like a strong bull trend. So, and if you're a bear, do you look at this and say, wow, it's just a pullback in a bear trend? Or do you say, something doesn't look right? It looks like maybe this might be a retracement from that, a pullback from that. So it doesn't look right for the bears, doesn't look right for the bulls. Probably a trading range for the next hour. Limit order traders. Sell the 10 high, sell higher, buy around the 7 high, buy lower. And if you're lucky, we'll get a decent sell signal bar up here or a decent buy signal bar down here for a stop entry. Get a decent sell signal bar up here or a decent buy signal bar down here for a stop entry. Bar 12, the end of the hour, and we're still right at the midpoint of the hour. Sellers above 10, but most of them will scalp out with 5 points. Will they buy the 11 low? I think only if they use a wide stop, because if this is a trading range, they're buying far above the bottom, and you can only do that if you use a wide stop and are willing to scale in. Remember, the market has been extremely bullish for several days, and the bears have not done enough to convince traders they have taken control. So, there's a bullish bias in the market that reduces the chances that today will be a very big bear trend day. Bulls trying to get a breakout. A breakout is a big bull bar closing near its high and closing above the high of the prior bar, and preferably closing above many prior bars. And if they get it, they'll try to get a measured move up. Yesterday, bar 59, big bull bar closing near its high, closing above the high of the prior bar. So you got to be thinking the market will probably rally for a measured move up. And it went far beyond the measured move up. Bears want a parabolic wedge, 3 legs up, 1, 2, 3. We had a new low, but this could be the first leg of a wedge, so it could be 1, 2, 3. A lot of times a wedge will begin before the bear trend ends. That's really common. And bulls are hoping that we are resuming this. But this is enough of a sell-off to generate confusion, and it'll make the bulls hesitate. So chances are, as strong as this is, it's still going to be a trading range. It's possible the trading range forms and just goes sideways up here instead of all the way back down here. What happened to that big bull breakout? Right? Trading range, disappointment. So the traders who bought as the market was forming a big bull bar, and now they say, oh my gosh, so what happened? All right? Trading range behavior. Expect disappointment. Look at the past 8 bars. All of them have prominent tails. That means all of them went one way and then the other way. So it was bullish 2 minutes ago, and now it's bearish. Do you buy up here? No. Do you sell down here? No. Remember, there are limit order bears who sold the 7 high. They sold more 5 points higher and 10 points higher. Right now, it's at their average price. They could get out without a loss. So it was reasonable for the bears to sell the 7 high if they're willing to scale in. And 80% of the time, you can avoid a loss. So if they sold here, sold 5 points higher and 10 points higher, it's back below their average price, and they could get out without a loss. But they may hold, betting that we're going to come back below the 7 high, and then they can get out break even on their first sell, and with 5 points profit on their second sell, and 10 points profit on their third sell. So for the bears, a lower high major trend reversal, but 12 did not close below 11, did not close on its low. So it's confusing. It's disappointing. So what do? Do you sell below 12? A wedge, a lower high major trend reversal. You have a bull trend, a strong minor reversal. And if you get a second reversal, there's an increased chance that it'll be major, but it's just not good enough. This still looks like a pullback from this. This choice right here, wait. Limit order bears has sold the 10 high, right? They tried to sell more 5 points higher. Did not go up enough for them to sell 5 points higher, but they're still hoping it falls 5 points below the 10 high for them to make money. 5 points is 20 ticks. If they sold at the 10 high, it has to fall one more tick than where their limit order is, so it has to fall 21 ticks. Bulls are hoping we hold above the moving average. Now, bar 12 was the end of the hour, and that was the midpoint, and we closed below the midpoint. So the bears won the first hour. But when it closes very close to the midpoint of the hour, yeah, it closed below, so the bears were slightly better than the bulls. But that's not enough to place a trade based on that. You don't sell based on the market closing below the midpoint. But it's a reminder that the bulls did not do enough. Bulls trying to hold around a 50% retracement of this and above the moving average. You can see we're just about at a 50% pullback and at the moving average, but that 7 high is a problem for the bulls. It's a bad buy signal bar. Therefore, it's reasonable for bears to sell it and to sell more higher, especially after this. So chances are we're going to come down to that 7 high. The bears then can buy back their shorts. So we know there are bears buying at the 7 high. The bulls know that. So what are the bulls going to do? They're going to look to buy at the 7 high and buy more 5 points lower, and they'll buy at the 7 low. Limit order traders looking for quick profits. They want to sell high, even when the market is very strong, and they want to buy low, even when it's strongly bearish. Sometimes it'll just dip a tick below the key price and then reverse. So bears are buying at that red line. The bears have sold the 7 high. They sold more 5 points higher. They sold more 10 points higher. So there are a lot of bears with buy orders at that 7 high, getting out break even on their first sell and with a profit on their higher sells. If there are enough buy orders there, a lot of the bears will start to panic and say, oh, it might be more of a trading range, maybe it won't get there. So some of the bears, instead of trying to get out break even on their first sell, will place a limit order a few ticks above. And if enough bears place a limit order slightly above that price, we'll get a higher low. And the same with the bulls. If they wonder maybe we will not get all the way there, maybe they'll place their limit orders a little bit above. We can do this. So a lot of the bears who sold the 7 high and sold more higher, and they're seeing it starting to bounce, they quickly buy back their shorts, and that's what's causing this. The bears who tried to get out at 7 are afraid it might not get there, and they bought back their shorts, and that did that. Now, can you buy above 13? I would not. We have a wedge, 3 highs, so it's a channel. I don't draw the lines below, but there's a channel, and chances are we're going to get a second leg sideways to down. A wedge is a type of a climax. Whenever you have a reversal from a climax, you typically get a couple legs sideways to down. So I would not buy above 13. We have 2 dojis here, a micro double bottom, and a rally. We have 2 dojis here, around a 50% pullback. Again, touching that breakout point, that August 18 low. Over here, we broke strongly below it. Now we're back at it. The market is trying to see if the breakout will fail and that we resume back up to a high, or if this is just a pullback from a head and shoulders top on the daily chart. We have a left shoulder, a head, a right shoulder, and we broke below the neckline, and we're testing the breakout point. I said we would get above that breakout point, and that's one sign that this is not going to lead to a major bear trend. Limit order bulls who bought that low and bought more 50 points lower, 100 points lower, were able to make money. So head and shoulders top, yes, but probably not the start of a big move down. Now I said we have a wedge, 1, 2, 3. Should get a couple legs sideways to down. We have 1, and now a bounce, and then 2. Is that enough? Probably not. I still think we're going below the 7 high. That's why I still have that red line there. But I also think that we're in a trading range, so I think we're going to try to go back up again. But will it try to go back up from here or from below here? Will it be 2 big legs down, 1 pull back, 2, and then try to go up? The bears are hoping 12 is the start of a bear trend, a lower high major trend reversal. And so far, 14 is a low one, but nobody wants to sell that far below the high in what's becoming a trading range. So not a lot of sellers below 14, not a lot of buyers above 13. We're in the middle third of a developing trading range, and that's usually the worst place for stop order traders to enter. They don't want to be buying too high. They don't want to be selling too low. It's a limit order market. Limit order traders are trading. They sell before high They buy the 5 close. They buy the 7 low, the 6 low. They sell the 7 high, sell more higher. They sell the 10 high. They buy the 11 low. They'll buy the 7 high. They'll buy the 7 low. So probably fewer opportunities for stop order traders today. Okay, so it's a low one. It's a bear bar closing near its low, closing below the moving average, but it's still around a 50% retracement of this reversal up. So you can sell for a swing, hoping that this is a lower high major trend reversal, but chances are the reversal is minor. Well, not a very good sell. I was talking about the recession earlier. I think we're going to have a recession. Traders are wondering if the Fed will raise rates again in November. And, you know, we have a hot CPI today, hot PPI yesterday, hot unemployment report Friday. I think they'll raise rates. I think they should raise rates. And part of the reason is they got to front load all of this stuff because they cannot raise rates too close to the election. What's too close? 3 months before, 4 months before, you know, or any time in the election year. You know, the Fed does not like to raise rates in the election year. That's putting their thumb on the scale for whoever's running against the incumbent, and the Fed won't want to do that. So I think they would rather get all the rate increases done before the election year. So I think they'll probably raise rates in November and then do nothing until the spring. And then if inflation gets down below 3, you know, 2.9, 2.7, I think after a month or two, they'll start to cut rates. So sometime, you know, April, May, June next year, I think they'll probably cut rates because they'll be afraid of the market entering a recession. The purpose of the Fed has 2 purposes. One is to keep inflation at a tolerable level, and 2 is to maintain employment. So keep people employed so they can make money, and keep the inflation down so that people can afford to buy stuff. That's the whole purpose of the Fed. And they basically have one way to do it, and that's adjust short-term lending rates, the rates at which banks borrow from the Fed. And the effects of their rate cuts and their rate increases take a long time to play out. So after the final cut, after the final rate hike, it'll take many months before the inflation gets halted, and they hope inflation gets halted before the companies start to lay off too many people and cause a recession. And it's a difficult balance. And usually, if you have a lot of rate increases, you're going to end up in a recession. And I've showed that list of other things that are reasons why a recession is likely. So I think we will have a recession. I don't think it's going to be a major recession. Most recessions are not major recessions, but I do think we'll have a recession. And, you know, I've talked before that a recession means a significant slowdown of the economy. And you'll often hear people talk about 2 consecutive quarters with a reduction in the rate of GDP growth. So if the GDP is 3 this quarter, the next quarter it's 2.9, it's still growing. It grew at 2.9, but it grew less than it did the prior quarter. And if the next quarter is 2.7, it's still growing. It's growing at 2.7, but the growth is less than the 2 prior quarters. So that's 2 consecutive quarters where the rate of growth has decreased. And on the news, they'll call that a recession. But it's actually, that's not the way it works. There's this committee of 8 economists that look at many other variables as well, and then they vote on whether or not we have a recession. Okay, so the bears have sold to 7 high and sold more higher. A reasonable thing to do. They can buy back their shorts if they want, and bulls betting that the bears will buy back shorts are buying at the 7 low, or they'll buy on a reversal up from below that. They'll buy at the 7 high, or they'll buy on a reversal up from a dip below the 7 high. So that's what's happening. It's starting to reverse up, and bulls are now buying. The bears have already bought. They bought at the 7 high. Some held to see if we would collapse, and as soon as they saw it was not falling far enough and fast enough, then they bought back their shorts. I said we should get a couple legs down from the wedge. 1, 2, 3, 1, bounce, 2. But we're far enough down, and we have consecutive decent bear bars. This is probably not the end of the pullback. So if we go up, we'll probably have to come down again, 10 bars from now and form some kind of a double bottom. Confusing, right? Might be a triangle. We have a low, a higher low, and we have a lower high. So we may form a triangle and then decide whether to resume up or reverse down. Going back to what I was saying about a recession, the Fed causes recessions by fighting inflation, by raising interest rates. And at some point, the Fed stops raising interest rates. And a lot of people wonder if the Fed has already stopped. Others think maybe we'll get one more rate increase, maybe in November. And as I said, it takes a long time for those interest rates to slow the economy down, right? Businesses need to borrow money. Maybe they don't need to borrow money today, but maybe they'll have to borrow money in 3 or 4 months. And then they'll be faced with the high interest rates, if they're borrowing 4 months from now, and they may have to lay people off. So the interest rates take a long time to affect the economy. And if they start to lay people off, 3 months later, 6 months later, after the last rate hike, usually the average length of time between the final rate hike and the declaration of a recession is 13 months. So if I think July was the last rate hike. If July was the last rate hike, 13 months later would be next August. If November, in a couple of weeks, if that's going to be the final rate hike, then 13 months later would be next December. It doesn't have to be 13 months, but that's the average. So it could be 5 months, it could be 2 years. But I believe we're going to enter a recession sometime next year. Probably not in the spring, probably after March or so. And then the Fed will realize they overshot and the economy is slowing faster than they want it to slow, and then they cut rates. And when they cut rates, do you start buying? No, usually the first rate cut is bearish. It's usually done because the Fed is panicking that the economy is in real trouble. So you're probably not going to go up right away. You may bounce, but it's probably not going to be the final low. Outside up bar here. Remember what I said about outside up bars? That the bulls want the bar to close above the high of the prior bar, and they want the bar to close on its high. 16. Are the bulls going to get what they want? If they get it, then we have a higher or low double bottom and a reasonable candidate for the low of the day. But if 16 ends up with a fairly big tail and it does not close above 15, you'll get fewer bulls willing to buy above 16. They'll wait for one more bull bar. sideways. We have higher low, we have lower high, and we may get another lower high and then a triangle. Can you buy above 16? Taking a chance that if it's a triangle, 50-50 chance we'll get a big rally, 50-50 chance we'll get a big sell-off. So if you buy above 16, put a stop below 16, you're risking 10 points. To make 20 points, you have a 50-50 chance of getting it. It's probably more like 40% chance. But that's 16 is not good enough. If you're buying in a trading range and you're buying in the top half, you want to be buying above a perfect buy setup. The 16 has a conspicuous tail and did not close above 15. So I would wait to see if we start to break strongly to the upside. I'll put up a weekly chart. This is the, I'll turn this into a weekly chart. So this is the January last year high, and here's the October low. Let me not do that. Let me do it with this. Okay, so that's the all-time high. There's the low. We've been sideways now for 2.5 years. So up and down and up and down, and we're pretty much in the middle of it all. Now, we sold off, we rallied, and now let's say we rallied from here. No, that's not what I want to say. Let's say in May, the board of economists decide that we're in a recession, right? The market, once they make the declaration that we're in a recession, the market is going to get a new low, right? The market has never made a final low in the bear trend before the declaration of the recession. So whatever low we have here or down here, next year when they decide that we're in a recession, it's not going to be the final low. We'll go lower. Also, the final low on average is about 2 years after the start of the recession. So the bottom of the stock market, the bottom could be well above this October low, right? So if we just go sideways for the next year and then they say we're in a recession, the final low usually comes a couple of years later. So, don't be too eager to buy after a recession. Inverted yield curve, we've had an inverted yield curve for about a year now, and it usually takes about a year after the inversion before the recession begins. We're already beyond that. Outside up, but did not close above the high of the prior bar, and the follow-through bar is a bear bar. Sideways in a tight trading range in the middle of a developing trading range. Not good for stop order traders, so better not to sell below 17, better not to buy above 16. Look to buy a reversal up from down here. Look to sell a reversal down from up here. So for a recession, I said you need consecutive quarters of declining GDP. Usually you want to see an inverted yield curve. Those are the two things you always hear about. They don't always lead to a recession, right? But there are other things that always lead to a recession. The Federal Reserve Bank of New York has a probability indicator, and it triggered a recession signal back in January. So that signal means we're probably going to have a recession. The ISM Manufacturing New Orders Index, that signals a recession. The Conference Board Leading Economic Indicators, that signals a recession. Inflation falling 2% or more from its peak, that has happened. That always leads to a recession. Unemployment rising 1.5% above its low for 3 months. That has not yet happened, but it will happen. And that has always led to recession. So those 5 things that I just mentioned always lead to recession. And we've had all of them except the unemployment rise. And we're probably going to get that. The interest rates hikes will probably lead to an increase of unemployment of about 0.5% above its low. So we have several things that have always led to a recession, and they have already happened. So I do believe we're going to enter a recession next year. On the recession, since World War II, the average length of a recession has been 10 months. So 10 months from when the board declares the recession to the time it declares the recession has ended. You know, I said that when the Fed cuts rates, they do it because they're afraid that the rate hikes are about to lead to a recession. So that first rate cut is usually a bad thing. The stock's not a good thing. You know, that first rate cut that they do, everyone looks at that and say, "Oh, the Fed believes we're going into a recession," and it's too late to stop it, and they're panicking by cutting rates. What about interest rates? Interest rates usually peak before the recession begins. And have interest rates peaked yet? Here's a 30-year bond chart. Okay, so is this going to be the final low in bonds, which means the final high in interest rates? Well, look at it. A really tight bear channel. It's a collapse. We may bounce and get a couple legs up, but it's probably not the end of the bear trend. When you have a strong sell-off and a strong reversal up, the first reversal is minor. If you have a second reversal, you have a better chance of getting a major bounce. So this is probably minor. We might have to get some kind of double bottom. I do think we're going to, this is so extreme, okay? I do think we're going to bounce either now or soon for many months. Here's the 2-year notes. Reversal up. Is this the final bottom? I doubt it, right? A very tight bear channel. Reversals up, even if they're strong, usually will not be, the first reversal up is usually minor. And another reversal up, not all that strong, probably minor, so probably will go a little bit lower. Wedge 1, 2, 3, 2 legs down, maybe 1 pullback 2, or maybe this is 1 pullback 2. So I think we're probably going to test down here. We got a flat moving average, and we've been sideways for 10 bars, just oscillating around it. Terrible for stop entry traders. If you sell below 12, do you get out above 13? If you buy above 13, do you get out below 14? If you buy outside of 16, you get out here. You can just lose a lot of money betting on successful reversals. The worst place to trade is in the middle of a tight trading range. Or another worse thing, selling at the bottom of it, buying at the top of it, or doing anything in the middle of it. That's that gap. I'll say something about gaps. You always hear that gaps always close. And, I always make the point that that is wrong. Gaps to the downside always close. Because the market has been in a bull trend forever. So it's always going to make a new high. So anytime there's a gap down, the market's going to close that gap. But gaps to the upside do not always close. There are gaps down here, and they're probably never going to close. You know, at a major bottom, if you start to get gaps on the way up, the market's never going to come down there. Right now, there's probably a 10% chance we're going to go below the pandemic crash low. It's 56% below the high, and 56% corrections are extremely rare. However, I do think we're going to go below this low sometime next year, the October low. So I think it'll be a big buy climax and 2 legs down, 1 pullback, 2. So not good stopover trading here. So not a great sell below 19. Okay, just a note for Richard. Anyway, you can see on the stock market, this is 2012. We had an extremely strong rally, a big sell-off, a rally to a new high, and then a second leg down. So right now we might be at this point, a first leg down and a rally. Maybe we'll get a new high and then a new low. I think we're going to get the new low. So right now we've had the big buy, we've had the big sell-off down to last year's October low. And right now we're here deciding whether we're going to get back up there or if we're going to go below this low. Here we went to a new high and then below that low. Okay, this is 2016. 1, 2, 3. There were several sell-offs there of 10% or more. 10% sell-offs don't mean anything. And here we had a 10%, a 20%, and a 30% sell-off. This is the pandemic crash, an expanding triangle. Here's that expanding triangle, and we rallied above it. And we had a 30% sell-off. A lot of institutions, a lot of traders, anytime they see a 10% sell-off, they buy, or a 20% sell-off, they buy. 30% sell-off is becoming pretty rare. And a lot of traders look at it as a great opportunity to buy. Anytime they see a 30% sell-off, if you're an investor and you can hold for 5 or 10 years, you should buy because the odds are extremely high that you're going to make money. So when the market falls 30%, traders buy. But is this the final low? Are we just going to go back up like this? I don't think so. I think this is big enough down, lasting long enough so that we'll probably have to go sideways. The bulls are hoping that last October's low is going to be like the crash low and that we just go straight up. This is what the bulls are hoping. They're hoping it's going to be like the pandemic low, a brief sell-off and a resumption up. But I suspect more likely we're going to get a second leg down. The second leg could begin below this high or above it. So I think we're going to get some kind of a double top. And I think we're going to go below this October low from last year. And then we'll have a double bottom. We'll have a better chance of getting a bull trend. Expanding triangle. Is it going to be like this in just a few years and then go up? Or is it going to be like this and take 10 years? I think it's going to be like this. So even if we go 5,000, 5,500, I think we're basically going to be sideways for about 10 years. And then I think we're going to do that. I think we're going to do this. But I think it's going to be about 10 years of sideways before we do. So basically screw the baby boomers. And I think that's what's going to happen over the next 10 years. That the baby boomers get screwed. So they have all these hopes of continuing to make a lot of money from stocks throughout their retirement, and instead we'll just go sideways for the entire decade. I'm a baby boomer, but I'm not going to get screwed. Anytime it's down 30%, I'm going to be buying, and when it's near the high, I'm not going to be buying. If anything, I'll be taking profits. Sometimes on TV, you hear people say that it's more of a stock picker's market for the next several years. Warren Buffett basically has said that. He said that back in the 80s, it was easy for him to make 50 to 100% return a year. And he said that if he was only trading an account that had $1 million, even today, he could make 50 to 100% return a year just trading stocks. But he said that his fund, he's going to be dead, at some point in the next 10 years. But he said his fund is going to have a hard time making a lot of money over the next 10 years because he thinks the stock market is not going to go up a lot higher, for quite a while. Very tight range and very difficult to do anything here. Can you be long, stop below 7, hoping we eventually go up? Can you be short, stop above 1, hoping that we get a series of lower highs and we go down? I think neither of those is good. I think it's better to wait for a good buy or sell signal bar and then bet on a swing trade. And sometimes the market will go sideways for 2 or 3 hours before it does, before it trends. It's like this, kind of sideways for a long time. And better just to wait. Here, in this case, we had a bull breakout. And even if you waited to buy about this outside up bar or this bar or that bar, you still could make 10 points, which would be an okay day. This is horrible. And then a bull breakout and then a reversal. And you could buy above that. 60-minute moving average, yes, yesterday's high. I don't want to be buying up here. I'd buy, if it broke strongly above it, I'd buy a pullback and I'd sell a failed breakout, either below that or either this or even this or that. There's still plenty of room down for a profit. One of the things that's difficult here, trading range open, you could buy that. I'd get out around break even if it started to do that. And if we had consecutive big bear bars closing below the moving average, and with the second body completely below the moving average and closing below everything to the left, that's sell to close, betting on at least a measure move down, and it went a lot further. One of the things that's difficult is when you get a boring open, when the market starts to move, it's easy to be in denial, thinking, it's just another trap. It's going to reverse. Well, if you see signs of a strong trend, it's usually worth placing the trade. So for the bulls, they want consecutive bull bars with decent sized bodies and closing near their highs and closing above the moving average. And the bears, they want consecutive decent sized bear bars closing near their lows and with the body of the second bar completely below the moving average. $60-minute chart, no pullback to the moving average and a lot of bars. We got near it, and we may have to get to it because we've been above the moving average for a lot of bars. A lot of times traders will want to buy at the average price instead of above the average price if it's been above the average price for a lot of bars. So I suspect we're either going to go sideways or down a little bit and get there, or we'll go up and then only up briefly and then back down. The bulls are trying to close this gap on this is the 60-minute chart, but that gap is also on the daily chart. And everyone's wondering if we're going to close the gap on the current rally, or are we going to pull back and then go up and close the gap? Possible low of the day, we have a double bottom, 7, 16, a bull outside up bar, 16, but a tail. And then a high 1 on 19, but a bear bar. And 20, a bull bar, but did not close on its high, did not close above 19. Bulls are trying to get a breakout here. But some of the bulls who bought up here right before the market collapsed are trying to rally it back there and get out around break even. They'll try to, and if enough of them do sell around here, we'll get a double top in addition to the double bottom. Very strong rally yesterday. So sideways, more likely we try to go up than down. But no good buy signal bar yet. 7, not very good. 16, 20, not very good. So we may have to get one more leg down. Are we always in long or short? I thought we went always in long 9, maybe always in short 15. But I think we're back to always in long. We're holding above the moving average. Bulls trying to break above 12, and they're trying to get back into that gap on the daily chart, which is that pink line. That pink line is the bottom of the gap. It's this high. We're very close to a 50% retracement of the September sell-off. So I do think we're going to get above that pink line, which is the September 50% retracement. This pink line is this high. So I think we're going higher. I don't know if we get there today. Okay. Consecutive bull bars, decent sized bodies, both closing above the moving average, and the second body completely above the moving average. So it's by the close. If you get a bear bar 22, you can get out below 22. The bears will try to get it out double top. Other bulls will wait for one more bar. They'd like it to close above 12, because we still might be in a triangle. Might get a third high after 2 lows. Triangles, you get either 3 highs and 2 lows, or you get 3 lows and 2 highs. In short below 22, a triangle, lower high, lower high. I would not, maybe if it's a perfect bear bar, you can sell it. We're holding above the moving average. And the bears want 22 to close on or near its low, and the bulls do not want that. The bulls don't want a bear bar, but if there's going to be a bear bar, they don't want the bar to close on or near its low. So they're going to buy into the close of 22, trying to prevent it from closing on or near its low. If it does close on or near its low, you'll get bears selling. They'll have a lower high double top and a wedge, 3 legs up, 1, pull back, 2, pull back, 3. Can you sell below 22 if it closes near its low? You can take a chance, but it'll be a triangle and a strong bull trend. Triangle in general, 50% chance successful bull breakout, 50% chance successful bear breakout, 50% chance the first breakout attempt up or down will fail. But I think it's more bullish than that. It's following a really strong rally. So I still think all of this is a pullback from this. So I think the odds are we're going to go up, but I'm not yet convinced that the move up has begun. At our minimum, for follow through, the minimum the bulls want is no bear body. So even if it's a perfect doji, that will be enough for bulls to buy the close, buy the market. Bulls want a breakout. They'd like to get a big breakout. And the bears want a double top or a triangle. But they'll need a really good sell signal bar because the channel up is tight. And this is still probably a bull flag, a pullback from this. So in some higher time frame, this is probably a bull flag. Here's the 5-minute chart. 15-minute short, very strong rally, a double bottom, a good buy signal bar. So it looks like the double bottom bull flag. 60-minute short, it's a high one pullback. Got another 11 minutes remaining in this bar. The bulls would like it to close near its high. Market's deciding, is it a triangle? And do we have to test down one more time before we try to get a bull breakout? Or has the resumption begun? The bulls need to do more. They need to break strongly above 12. And for the bears, they need a really good-looking bear bar, 22. Otherwise, traders are not going to sell below 22. Whenever you're waiting, you're probably in a trading range. Yesterday, there was no waiting. It's very clear by the third or fourth bar, fifth bar, that we were going to go higher. Okay, so for the bears, a double top, lower high, major trend reversal, but a tight bull channel and a bad sell signal bar. So probably buyers below 22. For the bulls, disappointing follow through, but still always in long. I'd get out the size of a scalp below 22, so 5 points below 22. If we get a bear bar closing below its midpoint, I'd get out below that. And for the bears, it's not good enough to sell. Bears are hoping higher high double top. Bulls have a higher low double bottom. For an interval channel, we have a higher low, we have a higher high. But we're also in a trading range. Not enough traders willing to buy high. Now, this is kind of a micro double top, up on 21, down on 22, up on 23, down on 23. Can you sell it? To me, it still looks like a minor reversal. So I still would not take that sell. We're right above the moving average. Bulls, reasonable to get out at some point below a bear bar closing near its low. If you get out below 23, well, this could be a small pullback bull trend. We have a 7-bar bull microchannel, every low at or above the low of the prior bar. And a lot of times, small pullback bull trends will get bear bars early on, yet the market keeps going higher. So you have bulls buying the close of 23, hoping it'll be like 60 yesterday, a big bear reversal bar, but the next bar never went below it. We just kept going up. Sometimes in a small pullback bull trend, I talked about this the other day. Sometimes in a small pullback bull trend, you see a possible low of the day, you see bear bars, and it's better not to take the shorts. This low went below that bear bar. This low went below that bear bar. Yeah, we still went up for about 10 bars. So it's better not to exit one tick below. It's better to exit maybe a couple points below, or rely on a stop below the most recent higher low. Because sometimes early in a small pullback bull trend, they'll get bear bars. And they're just traps. And the opposite is true with small pullback bear trends. A lot of times they'll get a lot of bull bars early on, but they're not buys. Better to bet against them. Bulls hoping that 24 will be a bull bar closing near its high. 24, the final bar of the hour, so its appearance affects the appearance of the first 60-minute bar, of the 60-minute bar. And a few minutes ago, the 60-minute bar was a big bull inside bar closing near its high. But with 23, 24, it's a lot less bullish. So you'll have fewer traders buying above that 60-minute bar. Reasonable to be out of longs. If you're in longs, I'd get out probably below 24. And for the bears, it's reasonable to be short, but I would not short it because a 7-bar bull microchannel, the first reversal down probably would be minor. I'd wait for a second reversal down. Bulls are hoping for a high 1, on 24. They're trying to get the 60-minute bar to close near the high of the bar so that more traders will buy above the high of the bar, which would be the high of 23. Still not clear. So still more likely trading range, less likely early in a strong bull trend. What do you do if 24 closes like this, a good sized bull bar closing near its high? We're still always in long. I think we're holding above the moving average, but I think it's really difficult to do anything. If another problem with 24 is it's low. Whenever you see a bar with a big tail below and the low of the bar is right at the moving average, a lot of traders will feel that the moving average was not adequately tested, and that will reduce the number of traders willing to buy above the high. It increases the chances that we'll have to dip more below the moving average. So even if 24 looks perfect, I'm not going to buy above it. And I did not sell below 23. So right now I'm going to wait for the market to go sideways and form a second reversal down, wait for a strong downside breakout and then sell, or wait for the market to go sideways and form another buy signal further below the high. So not good for stop entry traders. Since it's a trading range and since we're always in long, can you buy anything bearish? Buy the 23 close, the 23 low, the 24 close? I would not. I think it's better to wait to see if we reverse up from the moving average with a decent bull bar and then buy that. Think about the bears who sold below 23. At a minimum, they're hoping it falls far enough for a scalp. They're hoping that this is another attempt at a lower high major trend reversal. But they'll need more evidence that this is the start of a bear trend, otherwise they're going to get out pretty quickly. The bears that sold below 23 have not even made a scalp. So they got near a potential scalp and reversed up. Reasonable for the bears who sold below 23 to exit above 25. They don't have to. They could hold short, betting that will fail again around 410. On bar 1 we failed, bar 2 we failed, bar 12, bar 23. And for the bulls, I think 25 is not good enough after these two bear bars, two big bear bodies and then a small bull body. But right now we're still theoretically on the sell below 23, but it's only a swing sell. I would not. Personally, I think the best choice is flat and wait for more evidence of a bear trend. Not clear, so still trading range. Whenever you look at a chart and you can see a reasonable reason to be short, here a second attempt at a lower high major trend reversal with a decent sell signal bar. And you can see a reasonable reason to be long. We're getting higher lows and higher highs. So we're in a bull channel. Whenever there's both a decent reason to be short and a decent reason to be long, you're still in a trading range. Traders look to buy low, sell high, take quick profits, and you keep getting reversals. So bear bar, bull bar, bear bar, bull bar, bear, bull, two bulls, and some bears, now bulls. We just keep alternating control. Traders take quick profits. And anytime things look bullish, they sell, the close of 21. Anytime things look bearish, they buy, the close of 5, the close of 15, the close of 24. Better to do nothing here, even though we're still always in long and holding above the moving average. Are we going to get a breakout? Yeah. About 2 days a month, the market just stays in a tight range all day. So 10% of the time, this will continue all day. But 90% of the time, we'll get a breakout. And the range will get bigger. The range right now is only about 20 points, a little bit more, which is small. It's a small day. The day can get bigger in three ways. It can go below the low, fall for maybe a measured move, go above the high, maybe rally for a measured move, or go above the high, reverse down, go below the low, reverse up. And, so we get a little bit of breakout above and below. Normally, the market will break out before the end of the third hour. Right now, we're at the end of the second hour. Sometimes, like an FOMC day, the market will stay sideways right up to the FOMC and then have a breakout. That's the end of the fifth hour or so. But, chances are if we're going to get a breakout, it'll come within the next hour or so. But I think we'll have a hard time going much below the 60-minute moving average. So if we go to the downside, there's probably not a lot down. I think we'll have a hard time going above yesterday's high since it was so climactic. I think the market will have a hard time going above it. Also, it's at resistance level, the 50% pullback of the September sell-off, and then that the high from the other day, the gap. So I do not think today is going to have a big trend, but I do think it'll have a swing up or down. For a swing trader, is it better to be long or short? I think the better signal bar is 23. I think it's a better signal bar than 16. I think we're going to reach the 60-minute moving average either today or tomorrow. So if I had to be long or short for a swing, I don't know. It might be slightly higher probability for the bears. But right now I think the best choice is flat. Wait for something better. Wait for a double top, a second reversal down. Wait for a double bottom, a second reversal up, or wait for a strong breakout in either direction. Wait for 3 or 4 consecutive bull bars, 5 consecutive bull bars, or 3, 4, or 5 consecutive bear bars. This is even difficult for limit order traders. This choice, patiently wait, but don't give up, because we are going to get a swing. 90% certain we're going to get a swing lasting at least an hour, probably 2 hours at some point today. And the bulls hope it already started 16. The bears hope it already started 23. Good bar for the bears, closing on or near its low and closing below 27 and below the moving average. But can they get follow through? Can you short a stop right here and put a protective stop above 27 and take a chance that the bear trend has begun? If you do, I would trade small. Bulls are hoping for a double bottom 25. They're hoping 28 is a bear trap. But it's important to see that 28 closed below 27. That is significant. It increases the chances that we've begun a swing down. Bulls trying to undo 28. It'd be better if 29 does not become any bigger. If you get a bar that's too big, you'll get fewer bulls willing to buy because the risk is too big. Now, aren't we still on the short below 28, below 23? Well, we got higher low double bottom 20. If 29 closes above the moving average, I would get out of shorts above 29. And I really would not want it to get any bigger than it is to buy above 29, because I don't want to be buying too far above the low. So really not great. I would get out of shorts above 29. Might go outside up, 29 might close above 28. Well, you're buying at the top of a tight trading range, 25, and in the middle of a trading range day. Do you buy above 29 or you wait one more bar? I would probably wait one more bar. You can do it, or you can buy above 27, the neckline of this small double bottom, 25, 29. Or you could trade small and then buy more if it goes higher. The bears will try to get a reversal on 30, and the bulls are hoping that this is the end of the trading range and the start of a bull trend. You can see the hesitation, trading range behavior. Instead of the market racing up because bears giving up and bulls are eager to buy, no one is confident. Bears, I'd be out of shorts. Bulls, you can buy, but I would trade small and stop below 29. We have a double bottom 20. We have another higher low. And the bears want a head and shoulders top bear flag, left shoulder ahead, and they want this to form a lower high, which would be a right shoulder. And they need a good sell signal bar of 30. I'm currently flat. I did nothing over the past anywhere in here. Did not sell below 23. Did not buy above 25. Did not buy above 29. Did not sell below 28. We're getting in that zone where the market reversed down sharply, or 2 up and down, 12 up and down, and then up 21, down 22. But bulls trying to get trend resumption up. If we have consecutive bull bars closing above the moving average, with the body of the second bar completely above the moving average, which we have, and the bar closing on its high, that's a credible buy the close buy. So it's buy the market, buy for any reason. And you would not want it to fall below 30, so you're not risking too much. And for the bears, they want a lower high major trend reversal. Another attempt, they want a head and shoulders top bear flag. But right now, this is on a buy. Okay, so bulls are hoping this is going to be the start of a swing up. You can see more and more traders are buying. The bears want another sharp reversal down. The bulls want a bull bar closing on its high, closing above 23. And then they'll buy more, betting that we get back up into that gap. Bears are hoping to do this and that and that. Okay, I'm going to step aside. Bulls really need a decent bull bar of 31, otherwise they'll get out. Hope everybody has a good day.